Imagine this. You walk into a courtroom. Your heart is pounding. A judge is about to decide who keeps the house you built memories in, how your retirement savings will be split, and even how much you will pay or receive every month. Divorce is not just emotional. It is deeply financial. And if you do not plan ahead, the mistakes you make could cost you for the rest of your life. Today, I am going to give you the complete beginner-friendly guide to divorce. Financial planning. By the end, you will know the exact steps to protect your money, your credit, and your future. But here is the twist. There is one step most people skip, and it can quietly drain thousands of dollars without them even realizing it. I will reveal that later, so stay tuned. Number 1. Get organized with your finances. The very first step is gathering every single piece of financial information you can. This includes bank statements, retirement accounts, tax returns, credit card balances, mortgage documents, car loans, and even things like life insurance or health insurance plans. If you are going through a divorce, information is power. Without it, you are negotiating in the dark. For example, imagine you are fighting for a fair split of assets, but your spouse knows about an investment account you never tracked. That could leave you with much less than you deserve. A simple way to stay organized is to make a folder, digital or physical, and keep copies of everything. Think of it as building your financial survival kit. Number 2, understand. Marital property versus separate property. Here is where many beginners get confused. In most states, anything you earned, bought, or saved during the marriage is considered marital property, and it will usually be divided between you and your spouse. But property you had before the marriage, gifts given only to you, or inheritances can often stay separate. Let me give you an example. If your grandmother left you an inheritance of $20,000, that is likely separate property. But if you deposited that inheritance into a joint account and used it for household expenses, it could be considered marital property. Knowing the difference is key because this determines what you get to keep and what is up for negotiation. Number 3, protect your credit score. Divorce can wreck your credit if you are not careful. Why? Because joint accounts remain both partners' responsibility, even if a judge orders one person to pay. Let's say you and your spouse share a credit card. If your spouse stops paying, the lender does not care about the divorce decree. They will come after both of you. That late payment could slash your credit score by dozens of points. One way to protect yourself is to close joint credit cards and open accounts in your own name. Also, pull a copy of your credit report from all 3 bureaus. This way you can spot any accounts you might have forgotten about. Number 4, create a post-divorce budget. Once the divorce is finalized, your income and expenses will almost certainly change. Maybe you go from 2 incomes down to 1. Or maybe you are paying child support or receiving it. The budget helps you face this new reality head on. Start with your fixed expenses like housing, utilities, and transportation. Then account for variable costs like groceries and entertainment. Let me give you a real-life example. Sarah, a stay-at-home mom, suddenly had to handle all her expenses on a smaller income after her divorce. By creating a budget early, she avoided going into debt and even managed to start an emergency fund. Without a budget, it is easy to underestimate how quickly expenses pile up. Number 5, think about child support and alimony. These 2 can be confusing. Child support is money paid to help cover the cost of raising children. Alimony, also called spousal support, is money one spouse pays the other to help maintain a similar standard of living. The amount you receive or pay depends on income, length of marriage, and state laws. Here is an example. If John earns $80,000 per year and his spouse earns $30,000, the court may order him to pay both child support and alimony. It is important to understand how these payments will affect your budget. If you are paying, you need to plan for that expense. If you are receiving, you should not rely on it forever because payments can change over time. Number 6, divide retirement accounts carefully. Retirement accounts are often one of the largest assets in a divorce. Splitting them is not as simple as cutting a check. You may need a special court order called a QDRO, which stands for Qualified Domestic Relations Order. Without it, withdrawing money could trigger taxes and penalties. For example, If you have a 401k worth $100,000, your spouse may be entitled to half. But if you try to withdraw $50,000 and hand it over, you could lose thousands in taxes. With a QDRO, the transfer can happen without penalties. This is one of those hidden traps that could quietly drain your money if you do not know the rules. Number 7. Do not forget about taxes. Divorce has a major impact on your taxes. Your filing status changes. Who claims the kids as dependents changes. Even alimony and child support are treated differently. Here is a common mistake. Two parents both try to claim the same child on their tax return. The IRS does not allow that, and it can trigger an audit. Usually, the parent who has the child for more nights during the year gets the deduction, unless the divorce agreement says otherwise. Another example is selling a house. If you sell the family home during the divorce, you may face capital gains taxes. That is why working with a tax professional can save you thousands. Number 8. Rethink your insurance needs. During marriage, you may have had health insurance through your spouse's job. After divorce, you might lose that coverage. The same goes for life insurance or disability insurance. Ask yourself, who will pay medical bills? Who will take care of the kids financially if something happens to you? For example, one father forgot to update his life insurance policy after divorce, and when he passed away, the payout went to his ex-wife instead of his children. Updating your beneficiaries and making sure you have the right coverage is crucial. Number 9. Update your estate plan. Divorce is a huge life change, and your estate plan needs to match it. This means updating your will, power of attorney, and beneficiaries. Imagine if you forgot to update your will and your ex-spouse inherited everything. That happens more often than you think. A simple update ensures your money and assets go where you want them to. Number 10. Get professional help. Divorce can feel overwhelming. Attorneys, mediators, financial planners, and tax professionals can guide you. Yes, they cost money, but they can also save you from huge mistakes. For example, a financial planner can help you decide whether to keep the house or sell it. Many people think keeping the house is always best, but in reality, it can become a money pit. With expert help, you can make decisions based on facts, not just emotions. Number 11. The hidden money drain you must watch out for. Here is the part one promised earlier. The step most people skip. It is lifestyle inflation after divorce. When emotions run high, people sometimes overspend to feel better or to prove they are doing fine. Maybe it is buying a new car, taking expensive trips, or shopping sprees. These expenses can drain your settlement money fast. The truth is, the smartest move is often the least glamorous one, building a solid financial foundation, saving for the future, and avoiding debt. That is how you truly win financially after divorce. Number 12. Plan for housing stability. One of the biggest challenges after divorce is where you will live. Will you keep the marital home, rent an apartment, or buy something new? Each choice has long-term financial consequences. For example, keeping the house might feel emotionally comforting, but if the mortgage, taxes, and maintenance stretch your budget too thin, it can trap you in debt. Renting can provide flexibility while you rebuild financially. The key is to choose a housing plan that matches your new income and budget, not your old lifestyle. Number 13. Build an emergency fund. Life after divorce often comes with surprises, car repairs, medical bills, or even job changes. Having an emergency fund gives you a safety net. Experts recommend saving 3 to 6 months of expenses. For instance, if your monthly expenses are $2,500, aim for at least $7,500 in your emergency fund. This way, you avoid relying on credit cards or loans during tough times. It is peace of mind you cannot put a price on. Number 14. Keep track of legal fees. Divorces can become expensive quickly. Attorney fees, court costs, mediator expenses, and paperwork all add up. Without a plan, you could spend thousands more than expected. For example, a drawn-out custody battle can easily cost more than $20,000 in legal fees. Track every invoice. Ask your lawyer for cost estimates, and try mediation where possible to reduce expenses. Being mindful of fees protects your settlement from disappearing. Number 15. Rebuild your credit independently. Once you close joint accounts, you need to show lenders that you can handle credit on your own. Start with a secured credit card or a small personal loan. Pay bills on time, keep balances low, and steadily increase your score. For example, one newly divorced woman opened a secured credit card with a $500 deposit. Within a year, her credit score improved by more than 60 points. That helped her qualify for an apartment lease and later a car loan on her own. Number 16. Plan college costs for children. If you have kids, divorce raises big questions about who pays for college. Will both parents contribute equally, or will one shoulder more responsibility? Many parents forget to include this in their divorce agreements, leading to conflict later. For example, one father assumed his ex would help with tuition, but nothing was in writing. When the time came, he ended up covering the entire bill. Including clear terms for college savings or contributions in the settlement avoids surprises. Number 17. Protect sentimental assets. Not all value is measured in dollars. Family heirlooms, photo albums, or items with sentimental worth can create conflict in divorce. If you ignore them, you might regret losing things that cannot be replaced. For example, one woman gave up her grandmother's wedding ring in exchange for a small piece of furniture. Years later, she wished she had prioritized differently. Make sure to list sentimental assets in your planning so they do not get overlooked. Number 18. Consider healthcare costs. Divorce can double your medical expenses if you lose coverage from a spouse's plan. Compare COBRA, continuation coverage, marketplace health plans, or employer options. For example, COBRA may allow you to keep the same insurance temporarily, but it often costs hundreds more per month. If you plan ahead, you can avoid gaps in coverage and budget for the higher costs. Healthcare is one of the most overlooked expenses after divorce. Number 19. Review joint business interests. If you and your spouse owned a business together, divorce makes things complicated. Will one of you buy out the other? Will you keep running it together? Or will you sell it? For example, two spouses who owned a bakery decided one would take over daily operations while the other accepted a buyout. Without a clear plan, businesses can collapse under divorce stress. Getting a proper valuation and written agreement ensures fairness. Number 20. Watch out for hidden debts. Sometimes, one spouse racks up debts the other does not even know about. Credit cards, payday loans, or personal loans can all come as a shock. If those debts are in both names, you could be legally responsible. Pulling a full credit report helps uncover these hidden obligations. For example, one man discovered during his divorce that his spouse had secretly taken out a $15,000 personal loan. Because his name was on it, he became responsible for half. Number 21. Prepare for lifestyle changes. Divorce often means a lower household income, and that usually requires lifestyle adjustments. Maybe fewer vacations, driving a more modest car, or dining out less. While it might feel discouraging at first, many people find that simplifying their lifestyle reduces stress and opens the door to new opportunities. For instance, one divorced couple sold their large home and both downsized. That freed up cash for savings and reduced financial tension in their new lives. Divorce is one of the hardest transitions in life, but it is also a chance to rebuild and create a fresh financial start. If you take control of your money now, you can avoid years of regret later. The question is, what part of divorce financial planning do you think is the hardest? Dividing assets, protecting your credit, or creating a new budget?